What is up? And welcome back to How to Invest in Commercial Real Estate. We are back.
Been a while, hasn't it?
Yeah, man.
It's
people hard to get us all in the same room.
Yeah.
Harder than I'd like.
They're itching for our content.
Yeah, they are.
Maybe not, but we're going to give it to you.
Yeah, give it to them anyway.
Give it to you anyway. We're not doing it for you. We're doing it for us. We're kind of doing it for you, actually.
The number one podcast when you Google how to invest in commercial real estate.
Yeah, I don't know about Google, but if you go into Spotify or Apple Podcasts and you put in how to invest in commercial real estate, we're number one.
Okay, well, we're not stopping until we're number one on Google.
I own that phrase. We own that phrase in podcasting.
I own the phrase.
I said we. I immediately correct before you even said anything.
Hey, but do us a favor. If you're listening, check us out on YouTube and subscribe and hit the like button so we can build that part of our platform because that's probably the weakest part of the podcast.
Yeah, and definitely shamelessly, if you actually listen to the podcast, feel free to tap the review thing in Apple or Spotify. Leave us a review. It's always much appreciated.
Oh, be good.
Makes us feel less bad about ourselves.
We got a lot going on. We got some updates for you. So, Braden, hit them real quick with the updates.
Yeah, most recently, this week we just got back from a property tour. Brian bailed. He was busy doing things. Me, Joel, Andy, Jackson.
I like how Brian ended up not being busy, didn't say anything, and didn't join us.
Yeah, that was good.
You guys had it covered.
Yeah, we did, but no thanks to you.
I thought it would have been a waste of money.
Yeah, so we flew into Dallas, flew to Amarillo. We were in Amarillo by morning. Had to. Checked out Martindale, which we bought last year, did a little renovation on. That's looking good. New paint shop's up, new signage is up. They were doing asphalt repairs while we were there. That ledge that the homeless people were sleeping on, we took out.
Oh, good.
So,
that's a great plug
homeless
for the property.
people, watch out. We'll take your sleeping spots away. Don't be loitering. And then toured two other.
Only the best areas of town do we buy in.
Right. Hey, it's value add. We got to start somewhere, and we started low. It looks good. It looks good, man.
It looked a lot better. Yeah. Parking lot's getting done, getting repaired.
It's getting something, yeah.
Yeah. So,
and then toured two other ones that were about the level Martindale was when we bought it. So not, again, a very high bar of excellence, but we're going to come in and do the Criterion special on it.
Yep.
Paint, roofing, parking lot. It's amazing. Signage. I'll send you a picture to upload into this. There's a picture of one of these property signs, and it is bad, dude. It's leaning over, halfway blown away. It's amazing what some property owners and landlords won't do. And you can just see it. So, and then we caught a flight to Houston, connected through Austin. So we just did the Texas tour, man. And toured another one a couple of hours outside of Houston in a town called Victoria. Super excited. I mean, we're excited about that one. I'm not going to put super excited. But I think we've got a solid strategy here. We've got super well-occupied centers. We've got not bad locations, I would say, on all three of them. It's fairly good real estate, location-wise. We've got a plan that we just implemented, down the road, kind of at Martindale, and we don't have to get a ton of rent growth compared to where market is. We've just got to get them to start paying triple nets. So, I don't know. It's interesting. I'm excited to see what the investor feedback is going to be. I know we had an investor come with us, got some really good feedback. Yeah. We're going to continue to dial in through due diligence, but we've got that coming up. We've got closing of Landon Square coming up. That's probably going to be this week. So that's super exciting. That's been in the pipeline for a long time. We're doing a loan assumption and a B note on that one, so we're getting a pretty good blended rate. And then we still have the Richmond deal under contract. We got a dog sneezing back here. I mean,
seriously,
I don't even know whose dog.
It's rolling around.
Yeah. Okay. We got a deal in Richmond that's going to close less than a month, I think. We've got to be within 30 days. Yeah, we are within 30 days. We're getting the phase 2 deal worked out now. So we're 30 days away from closing the Richmond deal. We just closed the Fluorescent outparcel. Uh-huh. That was a 2-tenant Panda Chipotle deal. We sold. We bought that.
Real quick, we got to plug it. Guys, we talk about cap rates all the time. If you are a longtime listener to the show and you still don't know what cap rates are, go look it up. But we bought Fluorescent on a 9 cap, And we sold the Panda and the Chipotle outparcel at a 6.5 cap.
Yeah, off market.
Off market. So those 2.5 points, guys. That is where a massive amount of profit is, and so that gave that investment a good kick in the right direction. We're kicking back cash to the investors. We're paying down the mortgage. So it was a big win.
Massive win. Yeah, I love it when a plan comes together. Not only just in general, but so fast, right? We modeled this up kind of exactly how it's happening. We got the confidence to do that through our Plaza West deal where we didn't model it up. We just kind of had it as like a back pocket ace. This one, we definitely modeled up that we were selling it because we came off of that win. Again, we executed it. We bought that last summer, end of last summer.
No, like June.
Yeah, so we're well within a year.
And we sent back, what, 30%?
30% of the equity, and we paid down the note. We took it from like 8.6. We paid it down like $1.5 million. Nice. Returns are it's still going to be cash flowing great, and we've still got tons of upside with restructuring the rent on some of the big box stuff behind it, which we're getting a new leasing team engaged, so we should see some momentum on that this year. So all in all, a lot of momentum.
I don't even think you mentioned that we developed a Starbucks and sold it.
We developed Starbucks and sold it. Yeah, that's been a contract for months. Finally sold it. Painstaking process on that one, really. We have offers on the Owasso Strip Center. The Picklemans is in contract. Taco Casa is breaking ground Tuesday. The Five Guys building is under contract. The Aspen Dental is breaking ground next week. We've got 2 offers on our Grand Prairie learning experience. And Brian's like, do we have any updates? I'm still going. There's tons of stuff going on.
I don't remember saying that.
Yeah, we've had a great Q1. A lot of this is going to go out in our first quarter update. The newsletter already went out, so you should have already gotten an email on that. There's a lot of stuff going on. Excited to see the momentum coming.
So, topic for today, we wanted to kind of engage with the tariffs that are getting launched right now.
Yeah,
because the market is down.
Everything's down.
Everything's
except
down.
Prices.
Crypto's down.
Crypto's down.
Prices are up. Yeah. And so we just wanted kind of to give you our thoughts on how you guys can take advantage of this type of an environment. And most of the time people think, oh, prices going up, it's a negative. Inflation increasing, that's a negative. But when you own assets, inflation is not a negative. Why is that, Brian?
Because prices go up. Our assets go up.
Yeah, prices go up, inflation goes up, the value of assets goes up. And so we want to give you an example. So, I don't know, maybe we want to first talk about the tariffs and then we can go into the
Yes.
Okay.
They're not small numbers, and I think people have been talking about them for a long time, and that's why you've seen kind of the tick down since the beginning of the year. What are the new tariffs going to be? If it finally got signed, I think China's like a 67% number. Japan's like a 46% number. I mean, we've got like 90 countries with over a 10% additional tariff on them on goods imported into the U.S. These are not small numbers. That's obviously going to surge prices through the roof. That's going to cause momentary inflation. What does that do to consumer spending? That's a big deal. A lot of people are worried about that.
What you said, worried. That's it. As much as anything, it's uncertainty, right? So uncertainty makes the stock market go down, makes Bitcoin go down.
People flee to security in times of uncertainty, and the market and investing is not security. So maybe gold is going up.
Yeah,
10-year Treasury, people are buying those, so the yield on that is going down. That's actually good for commercial real estate.
It's potentially a great time to refinance some assets off of the treasuries. I was talking to a partner of ours this morning. He says he's getting quotes on refi sub 6.
Really?
Which you haven't seen since like 21, maybe.
And so let's talk about, now that we've talked about the tariffs, and I am not smart enough to know how this plays out.
Oh, no, we're from the future. We know exactly how this plays out.
I don't know. I'm not an economist. It's very complicated. So people that tell you, oh, tariffs are bad and, oh, tariffs are good, it's not that easy. It's way more complicated. And I don't think that we can have that discussion on this show, and we're not going to. No. But the tariffs will increase prices, and like you say, will increase inflation in the short term. And so how does that help you win in commercial real estate? And so I wanted to give an example of that. The reason inflation isn't bad when you own assets is because if inflation goes up, that's devaluing of the dollar. We can charge more rent for our buildings, and then the value of those buildings goes up because of that. Now you can say, well, the dollar devalue, you don't have any more money. Well, fine, I don't have any more buying power, but I have more dollars compared to other people, right? So therefore, your wealth is increasing. But let's say you have $1 million building and you put $200,000 down, and inflation goes up to 5% this year. And let's say you could monetize that by charging more rent. And so now my building isn't worth $1 million. Now it's worth $1,050,000.
Yeah. If it goes up 5%.
Yeah, if it goes up 5%. So you take that $50,000, that's the increase in your wealth, and you put it over your investment, which is the $200,000. That's a 25% return in just that year. And you're not even counting the cash flow. Yeah. You're not counting the amount you paid down your debt. And so high inflation grows the value of your assets. And because of real estate, we're able to leverage and buy and control or own a lot of assets. And so our wealth is supersized when inflation is high. Now, if you don't own any assets, inflation's a killer for you because you're getting a salary and that buying power of that salary is going down.
Yeah.
And so unless your employer gives you a much higher raise than inflation in a given year, you're actually earning less. But for us, our income isn't changing because we're collecting the same rent, maybe more rent. But it's that the power of having all of our assets go up in value while we sleep. That is the power of real estate or any asset class, really. I mean, even if you have like maybe you have a Monet sitting somewhere, right? Yeah. You're not going to monetize that this year, but that's why you see these record sales of rare assets is because inflation is increasing their value.
Yeah, and just to clarify, people might say, "Oh, well, you're going to get that 1 year increase." Well, we're going to have yearly increases in our rents, right? And so It's not just an increase one time; it's every year.
Yeah, and there's a couple of different ways you can evaluate rent growth. There's this term called mark to market, which is basically that your shopping center, let's use shopping centers for an example. Your shopping center is in like location and condition than another asset, but your rent is lower. There's no reason it should be lower. Generally speaking, it's the exact same piece of real estate. You should be able to take it to market, mark the market immediately and do nothing. And then you have this value add component, right? Where it's cheaper because it's not the same condition or quality or location, but through some sort of value add, you can then increase the rent, right? So you can do a combination of both of those in these high inflationary environments. And I think that's where we're kind of seeing some of the opportunity now is to go in with these shopping centers that could be pretty well located and in fairly good condition, but just could use an update, has a mismanaged owner, an absentee owner, whatever it is, and the rents are insanely low, right? We're going to get a combination of probably a free pop of just mark to market through these inflationary factors that we're talking about of the assets just going up, like things getting more expensive. We're going to be able to get rent growth just because, but we're also like adding some value and redoing the parking lot, right? Redoing the roof, cleaning up the mattresses, like laying around, literally mattresses.
So let's give some numbers. Go ahead. Did you have something?
No, go ahead.
Let's give some numbers. What drives the increase in rents, if you can think about it this way, is let's say I want to go build a new shopping center. The cost of construction is higher today than it was 10 years ago or 20 years ago.
Yes.
And so in order to make that make sense, I've got to charge a high rent. So you'll see in the really high growth areas with brand new construction, you may have $30 rents, $35 rents, $40 per square foot rents.
Yep.
And so then as you get to these older properties, like the ones we've been looking at just recently, where the owners let them go, they're run down, they're not in the new hot part of town, you may have, $15 rents. So now these businesses, they can save money if they don't need to be in the brand new area. They can go to these areas. But then the ones we're looking at, the owner is not taking care of the property. He's, maybe the roof has some leaks, the parking lot has some potholes, and he hasn't raised rents at all. Like you said, he's not even keeping up with that 15.
Yeah, so we're sub 10.
Yeah, you're $7, $6, $8 a foot rent. Because maybe he bought it years ago, she bought it years ago, and they cash flow, so he hasn't needed to. So our idea is that we're going to come and we're going to fix all the issues, really manage these well, treat the tenants right, and try to get them up to that 15 area, which is for the BC center.
Exactly. Not competing with the new construction, competing with the existing second, third generation retailers that we should be competing with.
Okay, and that could bring up another point. With a bunch of inflation, won't development slow down because people aren't going to know what is going to happen to their prices?
It's just like put more upward pressure on the rents.
When COVID happened, development slowed down, right?
Yeah. And so that was the other side of it. So we want you to know that even in a high inflationary market, how you win is owning assets. Okay, but the tariffs and the high prices and everything, that could slow down the economy. You could shoot us into a recession.
Yeah,
for sure.
Okay, now are you going to lose? Well, maybe, like in a recession, you may have some tenants that have a harder time paying rent, so that's a concern.
Yeah.
But you have a long-term lease, so they can't just stop paying. They would have to actually go under or file bankruptcy to stop paying.
Let's talk about COVID, right? We had like less than this many people that left our shopping centers. Like, I don't even know if it's more than 5.
We had very few. Most people just have to gut it out.
100%. Like, everyone is going through it. Yeah, we were killing it last year. This year's a tough year. Everyone knows that. We're making a little less. We're scraping it together. Generally speaking, we're not shutting down our business and going back to the job. You know what I mean? That's kind of the universal sentiment in recessions, at least from our portfolio. And that's dozens of properties spread out all over the country, hundreds of tenants, and we lost less than a handful.
But here's the amazing thing, guys, is that recessions are terrible, and when you're in them, you think they're never going to end, right? We're never going to get back to that growth. Yeah. Isn't that how you felt in 2020 during COVID? You're like, oh my God, the world's never going to be the same. We all felt that way in 2008 too, right? Yeah. 2008 crash was so terrible, but it was only about a year or two long, okay? And then what happens? The growth starts again, and everything goes back to normal. But here's the magic of a recession for commercial real estate owners, and we've talked about it on this show earlier, is that during that window, and it's already started on the 10-year Treasury, is rates go down. The Fed comes in and lowers prime. Everybody flees to safety, so the 10-year Treasury rate goes down.
Yep.
And that's all we need is that 1 or 2 year window. We can refinance all of our debt across the portfolio for 5. We can fix it for 5 years, 10 years.
At a lower rate than
at a way lower rate. And so then once that the growth kicks off again, we got our fixed rate really low. We may take a rate at 7 and refinance it at 4 or 5. And so now we get the benefit of that cash flow for the next 5 or 10 years. And so in a recession, we're going to win. In a high inflationary market, we're going to win. But the key is owning assets. If you don't own assets, you can't take advantage of either one of those.
I think it's Warren Buffett. It's got to be Warren Buffett. Warren Buffett's one of those. It's like Marcus Aurelius. He gets credited with all the amazing quotes.
Yeah, he's like the smartest human ever.
Yeah, exactly. So it's be greedy when others are fearful, and fearful when others are greedy. It's one of those moments, right, where we're just now going into this decline, and it's easy to look back. History repeats itself. Now is the time I would be aggressive. Now is the time where we're being aggressive. There's tons of opportunity out there. I would encourage people to go out and find some opportunity.
Yeah, and we don't. We'll wrap it up with this, but we're not being speculative. Like, the deals work at the higher interest rates that we're at now.
Correct.
And we tend to always want to keep enough cash on hand to handle a few tenants that leave. But if it works today at a high interest rate, then you just wait and bide your time for the interest rates to come down and lock in that low interest rate, and it really supersizes your cash flow.
Yeah, we're, like you said, we're getting deals to work when we're borrowing $8 million at 7%. When, like, 3 years ago, that number was 4. 3% on $8 million is $250,000 a year, just about. That's a lot of money.
Some people say, well, what if interest rates explode? That's a fair question. It did happen one time in our lifetime. Brian's the only guy that was around for that.
The only one.
But
I made it.
But that's okay. And here's just what I'll say to that is that we do have a little bit of risk in some of our developments because we have floating rates. Not all of them. Some of them we were able to get them fixed.
Yeah, and there's a couple of cash flowing stabilized retail deals we have floating rates on.
But we tend to not have a lot of floating rates. Most of our rates are fixed for at least 5 years. And so those hyperinflationary moments don't last very long. And so if you have 3 years left on your 5-year fixed rate, and you have a spike in high interest rates, but it comes back down before you have to refinance, and it didn't bother you anyway. So Anyway, all things to think about. The number one takeaway from this is you can win in a high inflationary market. You can win in a recession, but you have to own assets.
I like it.
All right. Till next time, guys.
We'll see you guys next week.